Welcome to the Stock Market Palantir. Today we are going to talk about RGTI.
Rigetti computing. It's really the quintessential deep tech equity right now, isn't it? It's sitting right on that speculative frontier of quantum computing. This stock is fascinating, I think, precisely because of all the chaos.
Exactly. I mean, over the past year, we've seen an extreme volatility cycle that kind of defies any easy explanation. A nearly 2,500% equity appreciation at its peak. It went from a potential delisting casualty to a multi-billion-dollar battleground stock. The core issue we need to analyze is this massive, almost unbelievable divergence between its speculative momentum and, any traditional fundamental reality.
Yeah, the question is stark. It's almost binary. Does this extreme market action represent a valid, high-risk valuation of future quantum advantage, the market simply trying to peer 5 years ahead? Or is it just a fundamentally unsustainable speculation, completely divorced from corporate reality?
And I'm going to argue that RGTI's price action isn't just random noise. It is driven by tangible factors. We're talking validated technological milestones, genuine strategic importance to national interests, and structural market mechanics that, when you combine them, justify this extreme high-risk premium. It's an asymmetric opportunity.
And I'm coming at this from the other side. I contend this valuation is fundamentally a fragile, speculative bubble. It's profoundly undermined by, frankly, glaring operational deficiencies, specifically minimal revenue, and this constant crushing process of excessive dilution that really punishes any long-term holder.
Okay, so my position starts with recognizing that the market is, I think, accurately pricing in the potential for quantum advantage. The retail market especially views this as, the next NVIDIA, a high beta way to get exposure to revolutionary computing. And that narrative is validated by these really crucial technological integrations, like their system's direct linkage with NVIDIA's NVQ Link platform. That right there ties RGTI to the massive multi-trillion-dollar AI supercycle story, which provides immense psychological fuel and, legitimacy.
Okay, I see why you think that. I really do, especially when you're looking at the narrative potential. But let me just introduce the cold reality behind that whole next NVIDIA comparison. This company, at a multi-billion-dollar market cap, a valuation usually reserved for firms with proven global commercial reach, reported only, $1.9 million in revenue in Q3 25. That figure wasn't just low, it was a miss against analyst expectations.
I recognize that 1.9 million is negligible. It's maybe even embarrassing when you view it through a traditional earnings multiple, but focusing only on price to sales is a historical metric. It's just ill-suited for a revolutionary pre-revenue technology where the time horizon for a payoff is, a decade away.
Even if you discard the traditional metrics, you absolutely have to address the methods they're using to fund this technological dream.
I will, but let's first acknowledge the non-dilutive validation they do have. The company has an implicit sovereign shield. Government contracts like the AFRL and DOE awards, totaling $5.8 million, validate the technology as a strategic national asset. The perception, which the market buys into, is that the U.S. government cannot afford to let a domestic quantum champion fail and outsource this technology race entirely. And crucially, they cured that de-risking threat organically. They traded up from below $1 to the $25 to $50 range and avoided executing the authorized 1-for-10 reverse stock split. That's genuine market confidence.
That is an interesting point about avoiding the reverse split. I'll grant you that. But that market confidence is constantly being weaponized against the existing shareholders. You just gloss over the real threat here. The company treats the stock market as a personal ATM. They utilized a massive at-the-market or ATM equity offering, reportedly raising $350 million. Now, while that unquestionably extends their operating runway, pushing cash reserves to $570 million, it severely dilutes existing shareholders.
But they funded their research lab. They secured years of runway. That is a necessity in deep tech.
It is a necessity, sure, but the structure of that ATM offering effectively caps the upside on every single rally. For listeners who might be less familiar, an ATM offering means management can essentially just drip feed millions of new shares onto the open market every time the stock price spikes. They instantly translate excitement into dilution. And what's more, there's a significant credibility gap because of this. Scrutiny of insider transactions highlights this perception that management is just cashing out, with specific allegations about the CEO's reported lack of direct share ownership and this heavy reliance on vesting options. The entire speculative mania is just a constant tug of war against the harsh reality of cash burn, minimal revenue, and continuous corporate dilution.
Well, this tug of war brings us directly to our first major point of disagreement: the battle between market mechanics and operational reality, specifically the squeeze potential versus that structural dilution cycle you're talking about. I argue that the mechanics are so extreme they can, at least momentarily, overcome the corporate reality.
Look, I acknowledge the existence of the classic squeeze metrics. This stock has significant short interest, hovering around 45 million shares, giving it a high Fintel squeeze score well above 50. I get it. But the fundamental truth remains. The structural overhang from the ATM dilution cycle ensures that any rally built on gamma mechanics is inherently short-lived. Every price spike is just utilized to dump new shares into the market. It suppresses any sustained long-term gains. It is a brilliant strategy for corporate solvency, but it's a disastrous one for long-term investors hoping for some parabolic appreciation that actually sticks.
I'm not convinced that the dilution cycle is the only thing determining the price action. We have to look closer at the market structure itself, which I think mandates volatile spikes independent of management's ATM activity. I mean, consider the gamma squeeze setup you just mentioned. When we see significant open interest concentrations in those out-of-the-money call options, say at the $40 to $45 strike prices, it means that as the price approaches those levels, the market makers who sold those calls are forced to buy the underlying stock to hedge their risk. That forced buying creates a feedback loop, the gamma squeeze.
Right. That mechanism is textbook, but it requires sustained momentum to work.
And that momentum is often fueled by regulatory necessity. We have to look at fails to deliver, or FTDs. RGTI exhibits these cyclical, massive spikes in FTDs, notably hitting nearly 300,000 shares back on October 17th. Now, for the audience, FTDs are shares that were promised to be delivered to a buyer but weren't. These failed trades require mandatory buy-ins under Regulation SHO, specifically Rule 204.
Okay, and why is that so significant for our debate?
Because these forced purchases, these mandatory buy-ins of hundreds of thousands of shares create what are often called mystery rallies that fundamental analysts just can't explain. And crucially, these regulatory mandated rallies operate entirely independently of the dilution cycle. Management can't control when the street has to cover massive FTDs. The risk-reward profile here, given the possibility of these squeezes, is asymmetric enough to justify the high beta trade, even considering that constant dilution threat.
That's a powerful argument for volatility, I'll give you that, but it's an argument for trading, not for investing. And those forced buy-ins, those brief flares of volatility, are often neutralized by the very same market microstructure once the institutions get involved. And that, I think, moves us to our second contention, interpreting those institutional flows. You argue that the entry of sophisticated institutional money provides a necessary floor.
It absolutely does. This is not just a retail playground. 13F filings show passive indexing activity. Vanguard increased its position by over 40%. That's forced buying because of index inclusion. But more significantly, you have sophisticated quant funds like D.E. Shaw initiating a large new position of over 12 million shares. These aren't passive buyers. They are providing an institutional floor because they view the volatility itself, the chaos we are describing, as a tradable asset class. Their involvement legitimizes the stock as a security worth trading, not just a penny stock gamble.
That's a compelling argument that institutional money has entered the chat, as they say. But have you considered that their involvement is often purely transactional and heavily focused on risk hedging, not necessarily directional bullishness? When you look beneath the surface of those 13F holdings, you find data that actually suggests suppression.
How so?
Well, look at the high off-exchange short volume ratios. They consistently range between 40 and 56%. I think it hit 56.57% on November 28th. This volume suggests that market makers are internalizing the massive inflow of retail buy orders, creating a simultaneous short position to provide the liquidity and then managing that risk in dark pools. They are selling short into the retail accumulation.
But that's just standard market making. They're facilitating trades.
They are, yes, but the consequence is that this high short volume doesn't mean it's a bullish institutional bet. It often reflects market makers deliberately suppressing price discovery on the lit exchanges. They are providing a necessary service, sure, but in doing so, they dampen the very rallies you claim are mandated by gamma or FTDs, preventing that parabolic move from really taking hold and allowing management more time to issue more shares via the ATM. So institutional participation, in this case, actually serves to control the chaos, not embrace the upside.
Okay, but regardless of whether the institution's intent is directional or just to harvest volatility, the liquidity and the presence of these major firms confirms that the underlying asset, the technology roadmap, is worth trading, worth hedging against, and worth paying attention to. And this brings us to the third, and in my view, the most important contention, the technology roadmap's credibility versus the current commercialization failure.
I'm sorry, I just don't buy that the roadmap justifies the current multi-billion-dollar valuation when the commercial execution is actively failing. The company is pricing in this distant 2027 vision of a 1,000-plus qubit system, yet their Q3 2025 revenue declined sequentially. The strategic focus on scalability through superconducting qubits comes at a significant cost, higher error rates compared to competitors like IonQ, which uses the trapped ion approach.
So why does the technology choice matter so much for the valuation right now?
It matters because commercial viability in quantum computing is compromised until Rigetti achieves their stated target of 99.5% median 2-qubit gate fidelity. Superconducting qubits scale well. They can pack more onto a chip, but keeping them stable and error-free is notoriously difficult. Trapped ion systems, like IonQs, tend to have higher fidelity right now, which makes them commercially viable earlier, even if they scale slower. Rigetti is essentially trading on a promise, that 99.5% fidelity, that they have not yet delivered. They're selling potential future monopoly rents before they've even cleared the basic hurdle of utility.
But that is precisely the point. And that is why sophisticated investors are involved. The market is entirely forward-looking in deep tech. The valuation is anchored entirely on the successful execution of that technological roadmap, not on Q3 revenue. Investors are explicitly paying for the probability of achieving those fidelity targets because the payoff is, well, it's existential.
So explain what hitting that target actually means for the stock.
It means confirming the viability of the entire superconducting approach. The current transition to the 84-qubit Anka architecture and the goal of achieving 99.5% fidelity by the end of 2025 is the singular major catalyst. Successful execution of those fidelity targets will violently close the valuation gap with their peers and will confirm that Rigetti has a viable path to scalable, low-error quantum computing. Investors are not buying the $1.9 million in revenue. They are buying the long-term option value and the potential for future monopoly rents if they hit that 1,000-qubit goal. That is the premium.
The challenge is they are funding a massive, capital-intensive research lab publicly, and the primary mechanism they use, the ATM, is inherently inflationary. Any success, any rally based on Anka or that fidelity announcement is instantly utilized by management to dilute the share count. They may secure their runway, but they simultaneously ensure that the long-term share price cannot sustain a stable, high valuation. It's a fundamental conflict of interest.
But they successfully navigated the existential threat of delisting. They secured their runway for years, and they have the strategic non-dilutive backing of government contracts that view them as strategically essential. They bought themselves the time necessary to execute on that roadmap.
And that's why this is such a fascinating security to analyze. You are buying time and you are buying volatility. You are not buying fundamentals.
In my view, RGTI remains a highly speculative venture capital-style wager, just with public market liquidity. Its price is protected by national security interest and propelled by these structural inefficiencies, like the high short interest and the FTDs. These market mechanisms, combined with the massive long-term option value and its aggressive roadmap, they justify treating this stock as a high beta trade despite all the risks.
And yet, while the technological potential exists, the current multi-billion-dollar valuation is precariously supported by speculative mania. It creates constant risk, the persistent threat of severe dilution from the ATM offering, and the fundamental disconnect between that high valuation and that meager $1.9 million in Q3 revenue. It means the stock is constantly fighting gravity. It is an extremely high-risk gamble on management's ability to fund a complex research effort publicly without destroying shareholder value in the process.
I think our analysis today really underscores the inherent challenge in the entire quantum industry, balancing this revolutionary technological potential with the brutal reality of pre-profit commercial execution. Whether RGTI proves to be a generational opportunity or a bubble depends entirely on which set of drivers an investor prioritizes: the powerful market structure and roadmap credibility, or the persistent threat of dilution and commercial reality.
Right. We covered the bullish gamma squeeze narrative driven by high short interest and the promise of technological milestones like 99.5% fidelity and the Anka architecture. And we contrasted it sharply with the bearish perspective, which is focused on severe dilution via the ATM offering and the fundamental weakness evidenced by that Q3 revenue miss.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.